Listen very carefully, because what just happened in the last 24 hours is not normal market behavior, and it's not going to stay contained for long. Silver exploded to $92.06 this morning. That's a $4.99 jump in a single trading session, a 5.4% surge in less than 24 hours. And if you think that's just another day in the silver market, you're about to see why this move is different from everything that came before it. Because this isn't technical buying. This isn't algorithmic trading. This isn't speculators chasing momentum. This is fear. Raw geopolitical fear manifesting as the largest single-day move in silver since the January crash recovery. And the trigger has nothing to do with COMEX inventories, or Shanghai premiums, or delivery squeezes. The trigger is Iran. And what's about to happen in the Persian Gulf over the next 72 hours could send silver to $100 faster than anyone is prepared for. Let me show you exactly what's happening right now, and why Bank of America's $135 silver target suddenly looks conservative instead of crazy. It's February 27th, 2026. Silver opened this morning at $92 after closing yesterday at $87, a $5 gap up overnight. And the catalyst was not economic data. It was not Fed policy. It was not Chinese demand. The catalyst was a military buildup that now includes 2 aircraft carrier strike groups in the Middle East for the first time since the 2003 Iraq invasion. USS Abraham Lincoln and USS Gerald R. Ford both deployed to the region with full strike groups. 12 F-22 fighter jets just landed at Ovda Airbase in southern Israel. That's the first time the United States has deployed offensive weaponry inside Israeli territory, ever. And according to reports from defense analysts, this is the largest concentration of U.S. air and naval power in the region in over 20 years. President Trump has made it very clear that military force against Iran is on the table unless Tehran agrees to permanently shut down its nuclear program. Iran has responded by saying they are ready for war. Supreme Leader Khamenei warned that any U.S. attack would trigger a regional conflict that could last months. And here's what the silver market knows that most people don't. When regional conflicts threaten the Persian Gulf, when 2 carrier strike groups position for potential strikes, when F-22s deploy to active conflict zones, silver doesn't ask questions. It moves first and asks later. Because geopolitical chaos is the one force that overrides every other factor in precious metals pricing. Stronger than supply deficits, stronger than industrial demand, stronger than speculative positioning. Fear is the ultimate bid under gold and silver. And right now, fear is bidding $92 for silver with no sign of slowing down. Now, let me show you why this particular geopolitical crisis is different from every other Middle East tension spike we've seen over the last decade. Because this time, the setup is perfect for a breakout that doesn't reverse when headlines cool off. Silver was already sitting at $87 before Iran headlines hit. That's only $8 away from the psychological $100 level. That's $13 away from retesting the January highs of $121. The metal has been consolidating for 2 weeks in a tight range between 85 and 90. Building energy, compressing volatility, setting up for the next major move. And geopolitical fear just provided the spark. When silver gaps up $5 overnight on war fears, it's not just a one-day pop that fades by the close. It's a repricing event. The market is telling you that the risk premium just changed. The baseline price just moved higher. And here's the critical part that most traders miss. Once silver establishes a new floor during a geopolitical crisis, it rarely gives that floor back even after tensions ease. Because the crisis reveals something the market was already pricing in underneath the surface. In this case, what the crisis is revealing is that silver at 87 was already too cheap given everything else happening in the market. COMEX inventories below 100 million ounces, Shanghai trading at premiums, March delivery demand building, industrial supply deficits in year 5. The Iran situation didn't create those fundamentals. It just gave the market permission to reprice them higher all at once, instead of gradually over weeks. And now that permission has been granted, now that silver has proven it can hold 90 plus, the path to 100 is wide open. Let me show you what Bank of America is saying about silver right now, because their forecast just went from ambitious to realistic in a single trading session. Michael Widmer, head of metals research at Bank of America, published a note earlier this month projecting silver could reach between $135 and $309 per ounce in 2026. Most people saw that forecast and thought it was insane. $309? That's nearly 4 times current levels. That's higher than the Hunt Brothers peak in 1980 when adjusted for inflation. That can't possibly happen. But Widmer's analysis is based on something very specific. The gold to silver ratio. Right now, gold is trading around $4,900 per ounce. Silver is at 92. That's a ratio of 53 to 1. 53 ounces of silver equal 1 ounce of gold. Historically, that ratio compresses during precious metals bull markets. In 2011, When silver hit $49, the ratio dropped to 32 to 1. In 1980, during the Hunt brothers squeeze, it collapsed to 14 to 1. If gold stays at 4,900 and the ratio drops to 32 to 1 like 2011, silver goes to $153. If the ratio drops to 25 to 1, which is entirely possible, given industrial demand dynamics, silver hits $196. And if we get a true mania phase where the ratio compresses to 14 to 1 like 1980, that's where Widmer's $309 target comes from. 4,900 divided by 14 equals 350. He's being conservative at 309. Now here's why the Iran situation matters for that forecast. Geopolitical crises accelerate ratio compression. When investors buy precious metals for safety, they don't just buy gold, they buy silver as leverage on gold. Because silver is smaller, more volatile, offers bigger percentage gains. And right now it's still trading 30% below the January highs, while gold is making new all-time highs daily. That spread creates opportunity. And when geopolitical fear drives capital into metals, that capital looks for the best risk-reward. Silver at 92 with a 100 target visible offers better immediate upside than gold at 4,900 targeting 5,200. So the Iran crisis doesn't just push silver higher on its own. It changes the allocation decision for every fund manager, and sovereign wealth fund buying precious metals right now, they were buying gold. Now they're starting to buy silver. And when that rotation happens, when even 5% of gold buying shifts to silver, the price moves violently because the silver market is so much smaller than gold. Now, let me show you what's happening on the supply side, because this is where the geopolitical premium becomes permanent instead of temporary. Fresnillo, the world's largest primary silver producer, just cut their 2026 production guidance. They revised estimates down to 42 to 46.5 million ounces from a previous forecast of 45 to 51 million ounces. That's a 10% reduction in expected output from the single biggest dedicated silver miner on Earth. Why are they cutting production? Because opening new mines takes 7 to 15 years. Because permitting is getting harder, not easier. Because the best deposits have already been discovered and mined. Because silver is increasingly coming from base metal mines as a byproduct, not primary production. And here's the part that should terrify anyone betting on lower silver prices. We are entering the 5th consecutive year of structural supply deficit. The Silver Institute projects that industrial demand will exceed mining supply by over 200 million ounces in 2026. That deficit has to be filled from above-ground inventories. COMEX vaults, ETF holdings, private storage, government stockpiles. But those inventories are already declining. And once they're depleted, once the buffer is gone, price becomes the only mechanism to ration supply. Which means silver doesn't go to 100 and stop. It goes to 100 and then keeps going until industrial demand finally gets rationed by price. Until some manufacturers say, we can't afford silver at 150, so we're shutting down production lines. That's how commodity shortages resolve themselves. Price goes high enough that demand destruction occurs, but we're nowhere near that point yet. Solar panel manufacturers are still buying at 92. Electric vehicle makers are still buying. Defense contractors building missile guidance systems are still buying. The AI data center boom requires silver for every server rack being installed. None of that demand is price sensitive in the short term because these are multi-billion-dollar projects with locked-in timelines and government subsidies. If silver goes to 100, they buy. If it goes to 150, they buy. If it goes to 200, they complain loudly and then they buy anyway. Because the alternative is halting production, missing deadlines, losing contracts, going out of business, so they pay whatever the market demands and pass the cost to end users. Which means industrial demand acts as a floor under silver prices, not a ceiling. As long as production lines need to keep running, as long as solar installations need to keep growing, as long as EV manufacturing needs to keep expanding, they will pay the price. And geopolitical crises make that dynamic worse, not better. Because supply chains get disrupted. Shipping routes through the Persian Gulf get threatened. Insurance costs for cargo vessels spike. Late times extend. Just-in-time inventory strategies break down. When the Strait of Hormuz becomes a potential conflict zone, when tankers might get attacked, when US and Iranian naval forces are exchanging fire, every industrial buyer in the world starts hoarding raw materials. They stop operating lean. They start building inventory buffers. They place orders for 6 months of supply instead of 6 weeks. And when thousands of manufacturers all do that simultaneously, spot prices explode. That's what happened with oil in 1990 during Desert Storm. That's what happened with palladium in 2021 during pandemic supply shocks. And that's what's about to happen with silver if US-Iran tensions escalate into actual conflict. Now let me show you the COMEX positioning data, because this is where the $92 move becomes even more significant. Managed money long positions in silver futures are still sitting near 20-year lows. 12,121 contracts. Think about what that means. Silver just moved $5 in a day, 5.4%. And the speculators are not even in this trade yet. The hedge funds that chase momentum, the CTAs that buy breakouts, the macro funds that allocate to trends. None of them are positioned for this move, which means all of that buying pressure is still ahead of us, not behind us. When silver crosses 100, when it makes headlines on Bloomberg and CNBC, when Reddit picks it up and retail FOMO kicks in, that's when spec longs go from 12,000 contracts to 50,000 or 80,000 or 100,000. And each 1,000 contracts is 5 million ounces of paper demand hitting a market that can barely supply the industrial buyers it already has. The math becomes absurd very quickly when you run those numbers. Let me give you a historical comparison. In 2011, when silver ran from $30 to $49, managed money longs went from 20,000 contracts to 100,000 contracts. That 80,000 contract increase represented 400 million ounces of new paper demand. Right now, we're at 12,000 contracts. If we just get back to 2011 peak positioning, that's 440 million ounces of buying. More than twice the entire COMEX registered inventory. More than the total global supply deficit for 2 years combined. And unlike 2011, when the rally was purely speculative, this time we have actual structural supply deficits supporting the move. This time we have industrial demand that can't be shut off. This time we have geopolitical crises that make physical holding more attractive than paper trading. The setup is better than 2011 in every way except one. In 2011, COMEX had plenty of inventory. In 2026, they're already running on fumes. Which brings me to March first notice day. Today is February 27th. First notice day for March silver contracts. The day when every contract holder must declare whether they're taking delivery or rolling forward to May. March open interest. Last week was 44,542 contracts. That's 223 million ounces of exposure. And after the $92 move this morning, after Iran headlines, after 2 carrier groups deploying to the Gulf, how many of those contract holders are thinking maybe I should take delivery instead of rolling? Because if this escalates, if shooting starts, if the Strait of Hormuz gets closed, physical silver becomes infinitely more valuable than paper silver. Physical means you have it. Paper means you have a promise that someone will deliver it later. And when geopolitical crises turn hot, when supply chains break, when borders close, when shipping stops, promises become worthless. Only physical matters. So what happens if even 20% of March contract holders decide to stand for delivery? That's 45 million ounces. COMEX registered inventory is below 100 million. They can probably handle 45 million without breaking. But what if it's 30%? What if it's 40%? What if the Iran situation escalates over the weekend and Monday morning opens with every long demanding delivery because they don't trust paper anymore? That's when the system breaks. That's when COMEX either delivers and goes to zero inventory or declares force majeure and admits the paper market was always a fractional reserve scam. And if that happens, if COMEX defaults on delivery obligations, silver doesn't go to 100, it goes to 150 or 200 overnight as the paper price becomes meaningless and only physical matters. Now, let me show you what's happening in the physical market right now, because this tells you where the real price of silver actually is. Dealers across the United States are charging $98 to $105 for silver eagles right now. That's a $6 to $13 premium over spot. Spot says 92, physical says 100. That spread has been widening, not narrowing over the past week as Iran tensions built. When physical dealers are charging 100 and spot is 92, that tells you the paper price is lagging the real market. It tells you that buyers are willing to pay more than COMEX says silver is worth to get metal in hand immediately. And when that premium persists, when it doesn't compress, when physical stays expensive even as paper moves higher, that's a signal. The signal is that paper and physical are starting to disconnect. That price discovery is shifting from futures to cash. That once the disconnect is complete, once COMEX loses credibility as the pricing benchmark, spot becomes irrelevant. Only physical prices matter. And physical is already saying 100, so when we cross 100 on the futures market, when spot finally catches up to where physical has been trading for weeks, that's not the top. That's the beginning of price discovery in a market where paper no longer controls the narrative. Now, I want to address the risks, because if I only showed you the bullish case, I wouldn't deserve your time. Silver can absolutely pull back from 92. Geopolitical tensions can ease. Diplomatic talks between US and Iran can succeed. Trump can decide the political cost of war is too high with midterms approaching. Any of those headlines can trigger profit-taking, can push silver back to 85 or 80 or even 75 in a matter of days. Silver is volatile. It dropped $40 in a week during January. It can do that again. But here's the difference between temporary pullbacks and structural breaks. The fundamentals underneath this rally are not going away. COMEX inventory is not refilling. Shanghai premiums are not disappearing. Industrial deficits are not reversing. Supply is not increasing. So pullbacks in this environment are buying opportunities, not exit signals. Every time silver dips, industrial buyers step in. Every time it drops, physical premium widens. Every time it corrects, delivery demand increases. The market is telling you that 85 is the floor, that anything below 90 is getting bought immediately. And that means even if we pull back from 92, we're not going back to 70 or 60. The base has shifted. The new range is 85 to 100. And the next breakout takes us to 120 or 130 or 150, depending on how fast speculators pile in. Bank of America sees 135 as conservative. I think they're right. Because once we cross 100, once that psychological barrier breaks, once media coverage goes mainstream, the FOMO buying starts. And when retail investors who missed Bitcoin at 60,000 and Nvidia at 1,000 see silver at 100 heading to 150, they pile in with everything they have. That's when positioning goes from 12,000 contracts to 100,000. That's when the real move begins. Now, let me show you one more data point that connects everything together. The gold to silver ratio is currently sitting at 53 to 1. That's historically elevated. That means silver is cheap relative to gold when gold makes new all-time highs every week, and silver is still 30% below its January peak. That's an arbitrage opportunity. That's the market saying silver has more upside than gold on a percentage basis. And when geopolitical crises drive capital into precious metals, when funds start allocating billions to safe haven assets, that arbitrage gets exploited. They buy silver as leverage on gold. They buy silver because the percentage gains are bigger. They buy silver because it's still under 100. That rotation from gold to silver is just starting. We're in the first inning. And when that rotation accelerates, when even 5% of gold buying shifts to silver, the price gap's violently higher because the silver market is 20 times smaller than gold. 5% of gold buying is 100% of silver buying. The market can't absorb that flow without massive price appreciation. And right now, with Iran tensions rising, with carrier groups deployed, with F-22s in Israel, that flow is beginning. The question is not whether silver goes to 100. The question is how fast. And my answer, based on current momentum, based on geopolitical escalation, based on March delivery demand, is within 2 weeks. By mid-March, we're either at 100 or we've had a temporary pullback that sets up the move to 100 in April. Either way, the direction is clear, the fundamentals are clear, the setup is clear, silver is going to 100, and once it breaks that level, once the psychological barrier falls, 135 is the next target, then 150. Then Bank of America's gold ratio targets come into play. This is not speculation. This is math. 53 to 1 ratio at $4,900 gold. Compress that ratio to 40 to 1, and silver is at 122. Compress to 32 to 1 like 2011, and silver is at 153. Those are not predictions. Those are calculations based on historical patterns that repeat every single precious metals bull market. The ratio compresses. Silver outperforms gold. Leverage buyers pile in. The move becomes parabolic. We're watching it happen in real time right now. $92 this morning. 94 by tomorrow. 100 by mid-March. 120 by April. 150 by summer if Iran conflict escalates. The math doesn't lie. The history doesn't lie. The positioning doesn't lie. And Bank of America's $135 target doesn't look crazy anymore. It looks conservative. Because when geopolitical chaos meets structural supply deficits, meets speculator positioning at 20-year lows, meets industrial demand that can't be shut off, you don't get a normal bull market. You get an explosion. And that explosion just started. $92, 5% in one day, $8 from 100, $13 from retesting the highs. The Iran situation gave silver permission to move. The fundamentals give it permission to keep moving. And the positioning data says the real buyers haven't even shown up yet. When they do, when those 12,000 spec longs become 50,000 or 100,000, when retail FOMO kicks in, when media coverage goes mainstream, we're not talking about 100 anymore. We're talking about Bank of America's targets, 135, 150, 200. Maybe even Widmer's extreme case of 309 if the ratio truly collapses like 1980. I'm not saying that will happen. I'm saying the setup allows for it. The mathematics support it. The historical precedent exists. And the geopolitical catalyst just provided the spark. $92 today, $100 within weeks, $135 by summer if this plays out the way every indicator suggests. The Iran crisis didn't create this rally. It revealed it. Silver was already coiled, already building pressure, already positioned for a breakout. The crisis just pulled the trigger. And now that the gun has fired, now that 92 is established, there's no putting it back in the holster. The move to 100 is inevitable. The only question is whether it takes 2 weeks or 2 months. And based on carrier deployments, based on F-22s in Israel, Based on Trump's rhetoric and Iran's warnings, I'm betting on 2 weeks. Because when two nations with missiles aimed at each other start making ultimatums, when military assets position for strikes, when regional allies start choosing sides, silver doesn't wait for confirmation. It moves first. It gaps higher. It establishes a new floor. And it never gives that floor back even after the crisis passes. That's what just happened. That's why 92 matters. That's why 100 is next. Geopolitical chaos just repriced silver. And the new price is heading to triple digits, whether the paper market is ready or not.